The investment topic that I'd like to talk about today is IRR, or internal rate of return. You can go on Google and look up the equation, and frankly, I'm not sure if I even remember what it is off the top of my head. It really doesn't matter. If you're in a place where you're doing an assessment of a project or an evaluation, you're probably working in some sort of underwriting software. Could be Excel, could be Argus, could be something more complicated, and the software will do the calculation for you. So I'm not here today to talk about the ins and outs of the calculation. I'm here to talk about what is IRR, internal rate of return, and why does it matter. So in simplest terms, when you're evaluating an investment, you're going to pay for an asset or a building in this case, or maybe a plot of land, and then build the building over time if it's a development. But you're putting out capital and you expect it to get paid back over time. If you're an investor in the market, you're looking at different buildings, and not only are the buildings physically different shapes and designs, locations, they've got different tenants, they're very different in lots of different ways, but they all have one common denominator, and that is net operating income, or income off the property. So in order first to understand what you're buying and compare those different assets, you need a common language of analysis, and that common language is net operating income. So you're going to be looking at a building that you're going to buy over time, and there's going to be cash flows. Most years, those cash flows will be positive. Usually they're growing. Sometimes, if there's a large um, capital event or other capital outlay in future years, or if you have to pay a large commission or something like that, your cash flow actually could be negative. And so to compare those different buildings, you need to run an analysis and you compare the internal rate of return of those investments, right? Because you're going to buy building A or B. How you determine that is which one is the better rate of return, or the IRR, internal rate of return. Now, the internal rate of return is a calculation that takes all future cash flows, be they positive or negative, and discounts them back to today. And the internal rate of return is the required rate of return, or the discount rate that would be required to make all of those future cash flows equal to the purchase price, which would mean that the net present value of that investment is zero. So the higher the IRR, the better the financial returns. Said another way, you have to be able to compare investments that are very different physically over a set period of time from one to the other. In order to do that, you need to know the cash flows, which are fairly easy to predict, although you're not going to know because they're predictions. And you need to be able to compare them. That's IRR, internal rate of return. The higher the internal rate of return, the higher the discount rate required to bring those future cash flows back to the value of the building today. So again, whether you can compare a $100 million investment to a $10 million investment by how much the IRR calculation returns. The reason that's important is you need to know what you're buying and you need to know how strong of a return it's going to provide. One of the things that gets a little bit tricky with IRR and internal rate of return is that they can be over different periods of time. So it helps if you're comparing similar periods of time, right? If you have a high internal rate of return project that only goes for 6 months versus a slightly lower one that goes for 10 years, the longer one might be a better return if you can't recycle that capital. Same thing for a large investment versus a small investment. You can have a high internal rate of return investment that's $1 million versus a slightly smaller internal rate of return investment that's $10 million. You would pick potentially the lower internal rate of return if you have $10 million to invest. You only have one of those $1 million projects, right? Because if you can't invest all $10 million, you're going to be losing out in the overall investment. So internal rate of return is just a concept that allows you to compare different building investments against one another over varying different time spans. And really what you're looking at is which has the better future cash flows compared to the investment today. So it's the discount rate that would be required to make those future cash flows equal to the purchase price today. A simple example would be if you had something that was a 10% IRR, that would be equivalent to a purchase price of $100. And then for every period, or for every year, or for every month that you're doing that analysis, let's just assume it's an annual analysis, every year, 10% IRR would be equivalent to cash flow of $10 in year one, $10 in year two, $10 in year three, all the way through to year 10. when you sell that asset for $110. If that was your cash flow, your internal rate of return would be 10%. So a higher internal rate of return would be greater returns, which would be better if the time span and the value, the purchase price are the same. Again, there's some nuance. If they're not the same, time spans are different. You have to take that into account depending on your investment goals. And if the purchase price is different, you have to take that into account. Because if you're an investor and you're trying to deploy all your capital, the amount of each purchase matters a lot. So bigger firms tend to make bigger investments because they need to deploy a lot of capital. So that's the basics of internal rate of return and why it might matter, and just some kind of details to think about as you hear people talking about internal rate of return.